Today I'm going to be talking about the latest trends in multifamily investing. And unless you've been living under a rock, some of these may be very apparent to you, but I'm also going to share some of the details about how exactly everything that's going on right now is impacting us as multifamily investors. And I hope that you walk away with tremendous value. I hope you walk away with action steps and insight in terms of how you can take advantage of this opportunity and these set of circumstances. Because if we're not careful, a lot of the complexity and the volatility that's happening in today's market may put you in a position of analysis paralysis where you do nothing. And I'm of the belief that we're either growing or dying. And I think this is an opportunity for us to grow. So with all that said, let's dive in. So what are the biggest trends in today's market? So those are really the topics that I'd like to really discuss and dive into in today's discussion. The first of which is that capital I, inflation. We have been talking about inflation. It's been on front page of every single news outlet for the past 12 plus months. Obviously, we've seen historic inflation. You continue to see a consumer price index print each and every month of what actually is going on with inflation in terms of the consumers. I would argue that inflation figures in all reality are much higher than that 8 to 9% that we've seen month after month after month over the past 12 months. But that is a big topic that is obviously impacting some monetary policy. It's impacting investors and equity and so forth. There's a lot to be said about inflation. Also, home mortgage interest rates is a big trend that's happening in the market. We've obviously seen the Federal Reserve make a lot of moves over the past 12 months and some historic moves from all-time lows back to some historic norms, and perhaps we've even got more runway to go. We'll see how things play out, but I've got some charts to talk about on that. Federal funds rates, you may say, well, wait a minute, isn't that the same thing? Perhaps, yes, but it's also impacting the way that we're financing some of these investments. So I want to talk about how that looks in the commercial real estate market and how that impacts investors. Also, we will be diving into some of the value volatility. We have seen some price corrections in the multifamily space across the country, and in some markets more than others, but I think there's something to be said about that, and these are definitely trends to be paying attention to. Also, there is insurance and property tax volatility that we are all encountering in today's market. So this obviously impacts two of the more substantial line items on our expenses for these properties. So obviously, at the end of the day, it all boils down to net operating income optimization. And when you have volatility and spiking costs for insurance and property taxes, that is an impactful thing to consider for investors. And then I've got a bonus, which we'll dive into just briefly about migration. Where are our occupants moving? Where are they moving from? Where are they moving to? And where is the puck going so that we can skate to where that puck is going and we can score a goal as investors? So these are the biggest trends in today's market. So let's dive in. Let's start with inflation. Inflation is obviously impacting consumers. It's impacting currencies. And consumers, obviously, it's the cost of goods. It's the cost of gasoline. It's the cost of food at the grocery store. It's the cost of occupancy in our rents. It's the cost of everything. At the end of the day, it's the cost of living. And buying power has been impacted tremendously for consumers across the United States. And we've obviously seen the growth of rents in the multifamily space, but at a certain point, there is a breaking point. And how much more can our tenants or our residents really afford? And I think that's a topic that we need to dive into. Currencies are getting impacted across the world. The United States dollar currently today is as strong as it's been in a very long time. That is impacting other currencies across the world that are pegged against the dollar. So, for the macroeconomists out there, I think it's a very interesting and very important dialogue to pay attention to in terms of what does that actually look like moving forward, and perhaps is the tide going out before that hurricane really meets the shore in terms of the United States dollar. So it's something to continue to pay attention to and be able to pivot when necessary. I'm not making any projections, but we need to look across the landscape and understand how does that impact us as investors. Ultimately, the dollar is kind of the foundation of a lot of what we do. And so we've got real assets, but it is important to pay attention to. Material pricing increases is another factor. One of the things over the past few years as investors, we've said, well, inflation, this is good. We've got an inflation hedging asset, right? Our rents reset based on inflation. Yes, that is true. And we have seen that. And some markets have seen 35% increases in rents, from 2 years ago to today. Others have seen maybe more like 15 to 20, which is all historically substantial, very, very substantial. I mean, historically, you see 2 to 3%. But the one factor that many investors have not really paid attention to until more recent time frame is the resulting material pricing increases when you're doing renovations and maintenance and repairs, and even new development. You are seeing this hit significantly in terms of material pricing increases. We're also seeing staff salaries increase on site. Now, when you own a large multifamily community, you staff that property with an on-site staff. We are starting to see in our own portfolio and across the country staff salaries, be in demand for increases. In particular, maintenance. Maintenance is in a very high demand, and that type of skilled labor is in short supply, and as a result, there is you're seeing a lot of staff salaries increase, which obviously impacts your expense ratio and so forth. Other labor as well, whether it's HVAC, plumbing, so on and so forth, you are seeing costs just go up significantly. So these are things that we need to be paying attention to as investors. And of course, we've seen historic rent growth, which is now starting to level off. I think we're starting to see some alleviation in that rent growth. You're starting to see that sort of cool off a bit. Obviously, every market is different, but some markets are at a different level than others. But that historic rent growth that we've seen over the past couple of years is starting to level off. And we're also starting to see some shift in occupancy and delinquency as a result of this tremendous inflation that has impacted consumers and really our consumers. At the end of the day, our success depends on the success of our consumers and our occupants. So it's important for us to understand, how is this impacting them? And also, how is this impacting the people that we're asking to support us in the operations of these properties? So that's really the high level of inflation. But ultimately, it comes down to the money supply. When you look at this chart from the Federal Reserve, and this is the Federal Reserve System of St. Louis actually published this chart, you can see that in 2020 we had a tremendous growth in the M2 money supply. Obviously, with COVID-19 hit, we had a massive worldwide global lockdown. As a result, the CARES Act was enacted, and money was falling from the sky everywhere, and it was being printed and created out of thin air. And so we had a tremendous increase in the money supply. And as you can see, this chart really illustrates exactly what happened. And you can tell that there's a lagging indicator that when you have that type of increase in money supply, that does filter through the economy. And we're starting to see that. And we've seen that in a big way over the past 12 months. The question is, where is this continuing to go over the next 12 months and beyond? And I'd argue that there's still runway for that. Let's see here. Go back to my little handy dandy chart here. Also, when you look at the CPI, there is here's another chart on the CPI, and it just kind of shows in historical context where things have gone for rent of your primary residence in the United States since the 20s to now. So we have seen tremendous inflation in rents since the 1920s to the 2020s. So over the past 100 years, I mean, that's been almost 10x, since that time. Sticky price consumer price index minus food and energy. As you can see, in recent times, we have seen a huge jump in that number. Since 2020, it dropped for just a brief period of time, but it has really skyrocketed. And you can look back in a more historical context, and you can see what we experienced in the 70s and the 80s, and you can put this into more context. but you can also put in context sort of that the climb there and how abrupt that has been and how volatile things have been as a result. And we can look back and say, well, what was the monetary policy of the 1980s? Well, if anybody's studied history, or if you are around at that point in time, conducting business, that interest rates went up to 15, 16, 17% in some cases to fight that inflation. So the question is, do we have a lot more runway to go? It'll be interesting to see that, and that'll be another part of the later part of this discussion. It keeps asking me to apologize here. It keeps asking me to click on the chart. Let's see here. There we go. Now, going back to the presentation here. So just a few other data points. This was actually a forecast from Marcus and Millichap early in 2022. They were projecting a 2.9% increase in employment. They were projecting a vacancy increase of 140 basis points versus 2021. They were also projecting 370,000 units completed in terms of new construction, and also were projecting about a 9.4% increase year over year in terms of rent. And I think a lot of that has proven to be true. Now, the next point that I want to touch on is home mortgage rates. Anybody who is watching this webinar knows, obviously if you're tapped in as an investor, as perhaps an occupant of your own primary residence as well, that 30-year fixed residential mortgages have jumped over double in the past 12 months, and even really less than 12 months. So now you're seeing roughly about 7% for a 30-year fixed residential mortgage versus 3% 12 months ago. And you're starting to see other products out there that sort of help alleviate some of that cash flow issue in terms of 35-year amortizations, even 40-year amortizations. But I do digress just slightly, but I think it's important to recognize, well, wait a minute, if this is the case, how is that impacting the housing market? Because everything is interrelated. As multifamily investors, we have to know, well, what are the options for our residents? And the options for our residents are either to form another household with someone else and sort of consolidate to protect themselves from prices, or it is to move up the totem pole and purchase a house. So how does that impact our occupancy? How does that impact our vacancy? How does that impact our rent rates? And I would argue that the growth in residential mortgage cost, in addition to, and some of the stuff I'll talk about, is really kind of the elevated pricing still on single family homes for residential occupants, which has remained flat after tremendous growth, is a headwind for a lot of our residents. And folks are saying, well, as a result, I have no choice but to continue to rent. And, I think that's a huge impact that we need to continue to pay attention to. Next, the housing market transactions have plummeted, yet prices are flat after historic growth, which is what I just mentioned. Rental vacancies are really seeing a downward pressure as a result. Now, there are some other sort of headwinds and tailwinds that are happening at the same time, where people are choosing to form other households or consolidate other households. So you're seeing that occupancy as a result somewhat tick up, but as a result of less people buying homes or less people being in that market to purchase homes because of that cost. I mean, if you think about the average cost of a new residential home in the United States, it's somewhere around the $400,000 mark. That cost has gone up from what the average was, call it around $2,000 a month to roughly $3,000 a month as a result of the increase in interest rates. Interest rate hikes are applying continued upward pressure on apartment occupancies and rent rates. And again, there are somewhat of crosswinds there as well. So these are things that we need to be aware of. So looking back historically, all the way back to kind of the early 70s, in terms of where we are. So historically, we're still quite a ways beneath where things were in the 70s to today. But you can see what happened in 2020, sort of going all the way down to basically zero to now this tremendous steep up climb in terms of interest rates in the 30-year mortgage average in the United States. So that's just an illustration to kind of show where we are in the historical context. Now, this one is basically talking about transactions. So historically, we're still seeing things that are rapidly growing. I mean, the number of transactions and the pricing of those transactions in the housing market has grown to all-time highs. So there's a lot to be said about that, but I would anticipate that to level off. But there is still a bit of a tailwind in that side of things in terms of just the level of demand and the limited supply of new houses. So there's definitely crosswinds there as well. This is interesting how it's doing that every single time. Housing inventory, again, this is kind of leveled off. It has grown through 2020, but you look at it and you say, well, the inventory from a historical standpoint is still much lower than it was even in 2017. So interesting and important data points to be aware of. Renter occupied housing units in the United States, is still at a very high level. You can see that dipped significantly during 2020, rebounded very quickly, and is really kind of leveled off. Apologize. Vacancy rate. Vacancy rate is really at a very low point, just shy of 6%. So call it 95.6% is really your occupancy rate in the United States for rental housing units. So, back in the great financial crisis of 2009, 2008, you can see that jumped all the way up to 11%. So the question is there runway here? I think in the grand scheme of things, we still have a very healthy rental market. And a lot of this has to do with home mortgage rates, but it has to do with many of these other factors as well that we're talking about today. So it's important to just understand where we are in the greater scheme of things here. Consumer price index for all urban consumers. This is rent for shelter in the U.S. on average, and this is what economists would describe as a sticky CPI figure. And what that means is that generally when prices go up in rents, they generally stay there. They generally don't go down or deflate. And you can see that has been the case since really the late 80s, early 90s. And you can see it's almost been, just completely up to the right. And it's nearly doubled since the late 80s, early 90s. So it's a very interesting data point to also pay attention to, because at the end of the day, you're going to get to a point where consumers are going to have some challenges to pay for rent if salaries do not continue to grow. And in some cases, there's no choice for salaries to grow, like I was describing, sort of in the maintenance field of our space. You're seeing there's tremendous pressure because folks are not going to do the work for you if they're not getting paid the wage that they demand. They're just going to go do it for someone else. It's not the case. It hasn't been the case across all industries that you're seeing salary growth to that level. And so it's important for us to understand, well, how is this actually impacting our consumers, and what are the different pressures in the marketplace? Personal consumption expenditures, and this is on housing, the rental of tenant occupied housing. So, ultimately this is just another price index, and it's showing the vast increase that we've seen over the past 100 years here, which has obviously been significant. But that really started with the inflation of the late 70s and 80s and has obviously accelerated since then. But you can see, since 2010, we've had a huge rise in this. Now, the salary needed to buy a home across the United States has increased as well. That's another factor that we've talked about. Not only the salary that's required to buy a home, that your average, according to this chart, the median home price is $370 or $360 or $360,000 roughly. I've seen other figures that have said more like $430,000. And so you've got rising interest rates along with price growth that's been historic over the past 2 to 5 years, really. But across the country, you're seeing folks that, if you want to buy a house, your salary has got to be fairly significant in comparison to the national average. So it's an important data point to understand, well, where do you invest, and what are the alternatives of your occupants or prospective occupants? And this is definitely a factor. Housing trends, again, I'll try to go through this fairly quickly, but ultimately these are things that, Marcus and Millichap was looking at through the second quarter of this year. And, the home ownership potential, which is limited by high prices and mortgage rates, you're seeing that, just continue to accelerate. The minimum annual income that's required to afford a medium price home has just continued to grow. And then the percent of households that qualify has plummeted. And you can see that even from 2019 to 2022, that's gone from 47% to 26%, that percentage of households that qualify to purchase a median priced home at sort of your average interest rate. So I think it's very, very interesting to understand that. And also to understand from a high level, how does the population break down in terms of income? You can see a little bit more than 7% of the overall population earns an income of over $200,000. And then just shy of 7% is somewhere in that 150 to 200. And, you cascade down the list there, but you also see 18.5% of the population earns $25,000 or less. And so understanding how is everything really impacting our consumers and our prospective residents is a critical factor. Because at the end of the day, if we're talking about 8 to 15% inflation, in addition to the interest rate hikes and all these kind of things, well, how much really disposable income do our residents have? These are things to really, really pay attention to as trends continue to develop. And again, of course, you're seeing the surge of rates, which is compounding on price escalation for new homes, has been tremendous since really 2020. So now moving on to my next point, the federal funds rate, which is the same really concept that I was just speaking about, which has impacted home mortgages, is also impacting us as investors when it comes to financing these deals. First of all, it has immediately impacted the yield or return on investment that we're seeing on some of these deals as a result of higher level of equity required to bring to the table to purchase, a similar price deal. And obviously we're seeing some price corrections, which we'll talk about a little bit later in this. Cap rate volatility, historically, there is a spread between interest rates and cap rates. And cap rates were at a historic low prior to all of these moves from the Federal Reserve. And, you're starting to see some of this volatility that's coming into play now, because cap rates that had, reached perhaps in some regards people would have described as a new norm, we're starting to see some changes there. But, some people would argue not enough changes to really compensate for the level of volatility and the level of increases that we've seen from the federal funds rate. We're also seeing the financing being impacted significantly. Deals that previously would pencil at a 75% loan to value are now penciling at a 60 or 65% loan to value. So the debt coverage service ratio constraints and the capital stack shifts as a result of that are highly impacting the level of yield and return on investment that we can achieve in the multifamily space. So this is definitely a big trend to pay attention to. Also, something that's interesting, this is more of an anecdote, sellers are still living in the first quarter of 2022, and buyers are living maybe in the fourth quarter of 2023. And I think it's very interesting because there's a bit of an impasse that it seems that, sellers are almost wanting to kind of hold on to what the market was a few quarters back, and buyers are kind of anticipating even further shifts and perhaps challenging developments on the horizon. So, that has impacted the level of transactions, and transactions have certainly dropped significantly. I saw a data point the other day, and I'm not sure if this is true or not, but I'll try to hold myself back. But I saw that there was a 27% drop in transaction activity in 2022 versus 2021. We're also anticipating a wave of terms expiring in 2023 on some of these notes. So we do anticipate some distress being on the horizon of folks that may be either over leveraged, overpaid, improperly financed their deals. So there may be some opportunities on the horizon there to find some distressed deals. But again, just going back to some of the interest rate conversation, you can see, I mean, the stair step has been significant. It's like climbing Mount Everest, and it went from nothing to extreme elevation there. And really, that started all this year. In the beginning of the year, I think it was March when the Fed first announced an increase there. And I think this is going to take me to the website here, so give me just a second, as usual. Well, maybe not. Let me stop screen sharing here for just a second. Sorry about that, Rama. All right. Now, that was really the only chart that I wanted to share on that section, really. But ultimately, it comes down to, look, there's been a lot of moves this year in interest rates as a result of the Federal Reserve's continued hikes. And we are anticipating another meeting next week, by the way, from the Fed. Many are suggesting perhaps a 50 basis point hike, whereas we've seen 75 basis points over the past several months. It's been pretty consistent, and Jerome Powell has indicated that he is committed to fighting inflation in a major way. And I think many investors at the beginning of 2022 would have said, well, I'm not sure what his capacity to do so would be, but I think he's obviously proven, that he's a man of his word, and they are committed to continuing to fight this. So we'll see. I think we should anticipate that things will continue to rise in terms of interest rates. But as a result, it's important to note that there have been value corrections in the market for multifamily product. I can tell you from my own perspective, from my own company's perspective, we're seeing a 15% plus pricing correction from historic highs in our markets, mainly the Midwest and the Southeast, but we're anticipating further corrections in 2023. In some cases, we're seeing 25% corrections in terms of pricing, which were from historic highs. I mean, I think that's important to note, is that there was a lot of what I would describe as irrational exuberance in the space, and people thinking, well, think values are going to just continue to run, and I'll buy it for this price, and tomorrow I'll sell it for, 30% more. And that worked for a period of time, but it seems like the music has stopped for the speculators in the market. And so as a result, there is certainly a benefit if you can figure out the Rubik's Cube of financing in today's market. And so we're seeing a big correction there. And for a long-term investor, that can be an interesting proposition. Commercial real estate prices for the U.S., if you look in 2008, 9, and bottoming out in 10 and starting to rise from there. I mean, there was a huge correction in pricing in the great financial crisis. And things have just continued to be sort of elevated, in terms of that growth there. But, looking back, you were seeing up to about a 30% decline at that point in time. And so it'll be interesting to see how things play out. But it's always important to study history and look at, well, how did the last recession play out? And what components of this correction are the same? This was 2022 investment outlook from Marcus and Millichap. They were projecting, and this was through the second quarter, they were projecting continued cap rate compression. They were projecting continued growth in price per unit, so on and so forth. So I think that it is interesting to just kind of look at that and look back to the projections, but also to say, well, how are things actually shaking out? We're actually not seeing as heavy of a cap rate move as I would anticipate moving into 2023. If interest rates continue to run, I would definitely anticipate cap rates to reset. And one of the things that is important is, once you get a very motivated seller that has no choice but to sell, at the end of the day, they're going to have to meet the market. I don't think you've seen as much of that just yet, but when you see more of these terms expiring here moving into 2023, I think you're going to see more sellers meeting the market for where it is. And at that point, we'll be able to really see what the price discovery on cap rates ends up being. I want to talk a little bit about insurance and property tax volatility. This has been a big one. There's been quite a few major loss events. If you think about Hurricane Ian, there was another hurricane. There was there was an ice storm in Texas, and many of you, the Texans listening, will know exactly what that was called. For some reason, I can't remember the name of that storm. But there's been a handful of major loss events costing these insurance company billions and billions of dollars in casualties and so forth. And as a result, the insurance companies are saying, all right, well, we got to make this up somehow. And so you're seeing property and general liability insurance premiums jump up significantly. And even our providers have indicated that we need to brace ourselves for 2023 as we look at resetting some of these. So I think that's something that we all need to pay attention to, and we need to keep our team honest on to be able to be as resourceful as possible to find, the most appropriate coverage for the most appropriate dollar. Tax collections have decreased as a result of some of the COVID lockdowns and some of just, economic turmoil that we've seen recently. So tax collections have decreased. So I think many industry leaders that I pay attention to are anticipating increasing property taxes. So these are all important factors for us to understand. These are two of the most substantial line items on our P&L, our insurance as well as taxes. So it's important to understand and anticipate how is this going to impact us and how is it impacting us right now. It's interesting to kind of look at this chart across the country and understand, well, where do the states that I'm investing in, how do they fall in the scale of property tax, sort of rates? If you look at the most expensive district is in Washington, D.C., and the least expensive in terms of property taxes, according to this chart, is Indiana. And so you can sort of see how things play out across the board. So every jurisdiction has a different way of handling property taxes. But of course, anticipating how things move forward, there's certainly a pattern in this. And I think this is an interesting data point for us to all understand and consider as we continue our investing. Lastly, the last point here is a bonus point. It's migration. Since 2020, we've seen what people are calling the Great Migration. Largely, people have been moving to the Southeast. Of course, the Mountain West as well is one. Idaho is one that's not listed here as just one example. But also, Florida, Texas, North Carolina, have been moving to places like that, or South Carolina or Georgia, from places like New York, California, Illinois, so on and so forth. So will this continue? I have some of my own ideas. Some of my ideas, in some cases, I think the inflation, will be an interesting factor to see how that impacts continued migration, because I think cost of living will continue to be a big factor. And I would anticipate that consumers will be looking for more affordable places to live. And so what caused the Great Migration in 2020, which is more of kind of a lifestyle, working remotely kind of migration, and leaving some sort of policies from a governmental perspective, and places that were open like Florida received a lot of benefit from that. But I think the next migration may be a little bit different. So I think it'll be important to watch how that continues to unfold as you want to skate where the puck is going. Because obviously population growth, job growth, those are huge factors in the success of investing in multifamily. So what other shifts should we anticipate? So I think it's important just to understand, well, how everything that we've talked about in today's presentation, how is this impacting our consumers? And how is this impacting us as investors? What other shifts do you anticipate? So where did people move in 2020, 2022? I mean, this is where most people were migrating to and from. And so you can see there's the Southeast did really well. Of course, Mountain West and, some sort of the Southwest did really well as well. And some of these other states where perhaps there was more challenging policies from a lockdown perspective or economic perspective, were kind of the losers in terms of the outbound migration. So it's important to look back, but it's also important to look forward and say, well, where are things shifting as we continue to move forward? So how does this all impact you? It comes down to equity. When you think about it from our perspective, we're sponsors and we invest our own equity in these deals, and we also raise private equity. We raise private capital from high net worth investors. And so it impacts the psychology of our investors. It impacts our own psychology to say, wow, things are choppy, things are challenging. And so the question is, well, is this an opportunity, or is this a elevated level of risk that is something that's, sort of a headwind for us? And, the return on investment is certainly impacted in the short term, but it can also be a benefit for us in the long term. Cash flow in the short term, we're seeing compressed cash flow as a result of higher debt coverage service ratios. Interest costs have increased significantly, and we have not seen a significant resetting of cap rates just yet. So cash flow has definitely been impacted in the short term. We're hearing from some groups that, cash on cash return expectations have diminished. But it'll be interesting to see how that plays out in 2023 and beyond as we really kind of get into the meat of what I would really describe as this recession or this next market cycle. Of course, volatility and risk is important for us to understand. There's things that are out of our control. There's things that are in our control. A lot of this has to do with, the market and the market giving, the market taking. But there's certainly a level of volatility and risk that, has really showed up as a result of all these factors. And then, of course, the overall return metrics and assumptions. I mean, I think it's the assumption piece is the most important part. One of the age-old debates that we have in our investment committee is, hey, when we look at a 5 to 7 year time horizon for an opportunity, one of the factors, as an example, is cap rates on the exit. It is interest rates. What is the interest rate environment? It's very difficult to assume where the interest rates are actually going to be in 5 to 7 years. But it's also important to just, to understand, well, best case, worst case scenarios, and can you live with both of those different scenarios? And, of course, across the board assumptions, it comes down to rent growth. It comes down to expense ratio growth. It comes down to occupancy. It comes down to delinquency. It comes down to other income. I mean, across the board assumptions, if you're going to be an effective investor, you've got to be able to understand the nuances of all of those different factors and properly assume, and also kind of hedge your bets and understand the probabilities of certain assumptions playing out. But I think return metrics, to a certain degree, we've got to take some heat off of what's actually been happening over the past few years. I mean, because again, there's, I believe, been a lot of irrational exuberance in the market and a lot of dumb money chasing, less than quality deals. And so that's made a lot of investors look perhaps smarter than really they have been. So just briefly, the CF Capital difference, this is all about our company. The centerpiece is cash flow. We do focus on cash flowing assets with an opportunity to increase value, increase cash flow, increase operations. But what we do is all day, every day, we are evaluating the market and we are stepping into this economic analysis that I've hopefully done a decent job of explaining to you today. I am not a macro economist, but I live in that world. Our team lives in that world constantly, because for us to be able to make assumptions, we have to understand the pulse of where things are going. But of course, with that, simultaneously, we're fostering best-in-class relationships across the board when it comes to our teams on site, when it comes to our legal team, when it comes to our corporate headquarters team. At the end of the day, it all comes down to great relationships. It all comes down to great partnerships. And so we're constantly building those partnerships. We're constantly partnering with investors as well, who we would describe as best-in-class relationships. And these are people that invest with us because they trust us and they trust that we're going to put them in the best position to succeed. Of course, from there, we're always looking at new acquisitions. In fact, at this point, we probably look at 125 to 150 deals before we acquire one. And so we're always out there kicking the tires, touring deals, underwriting deals, and making offers. But the acquisition then leads to reposition, whether that is through a renovation or optimizing the operations, repositioning the asset from a branding perspective, from a marketing perspective, so on and so forth. We're going in there and transforming that asset to meet and exceed the market's potential. And then ultimately it comes down to refinancing and disposing of those assets. So that's really what CF Capital is all about. And it is a circle that ultimately supports our partners and ultimately elevating those communities together. So a little bit more about CF Capital. We're a national real estate investment firm with a purpose. We provide property investment and asset management solutions to help investors maximize their returns on high-value multifamily communities. And these are passive investments for folks who don't want to deal with the tenants, termites, or toilets that we deal with on a daily basis. But our investments go far beyond acquisitions. We invest in people. And ultimately, we deliver tax-advantaged, stable cash flow and capital appreciation with a margin of safety. And ultimately, our purpose is to elevate communities together. If we do right by our residents, if we do right by our staff, if we do right by the community that we're investing in, it all comes back. And it's not about sacrificing ROI. It's actually about enhancing ROI as a result. And that comes down to the abundance mindset. When we give, we also receive more. And it's not a function of because we get to receive more, but it's also an ancillary amazing benefit. And we think that that's really playing the long game. And that's really what CF Capital is all about. So with all that said, Rama, I want to give my key takeaways here and just kind of talk about, in summary, we are in a very volatile environment. It's not easy to strike the right balance for risk and reward, but there are opportunities that exist if you know where to look. And I think it comes down to great relationships. It comes down to patience, diligence, and really opening yourself up to say, you know what, I'm in the game. Instead of pencils down, I'm in the game, and we are open to opportunities. And I think you've got to continue to press forward to find those. The storm could be lengthy, so be prudent. Here's one also. Uncertainty of this level is a major challenge, but it can create significant opportunities. When people are fearful, as Warren Buffett says, that perhaps can be a time to be greedy. And, you don't want to catch a falling knife because there could be some runway for this to continue to drop just a bit. So you want to pay attention to that. The good news about this market is that it is inefficient to a certain degree. It is slow to a certain degree. So you can see when things start to move prior to that really kind of being completely settled into the market. So pay attention, keep studying, keep having conversations like this, keep showing up to these type of events, and surround yourself with people who are evaluating. Align yourself with best-in-class partners. I know that we invest with other groups, people like Rama and his team at Usha Investment Group, and we also invest with others across the country, but we try to align ourselves with best-in-class partners. We invite you to align yourself with CF Capital as well, if that feels like a fit for you and your investment approach as you move forward. Ultimately, I think this is the most important bullet point of this entire slide, and maybe even the most important bullet point of the entire presentation, is focus on the fundamentals. Ultimately, we provide a service to residents. We provide a roof over their head. And if we can, provide great service to them on repairs and maintenance, if we can provide a great service to our staff in terms of leasing, and really at the end of the day, renewals, collecting rents, paying bills, staying on top of things, getting ahead of repairs, getting ahead of capital expenditures. At the end of the day, these are fundamentals. It's just like, in the game of basketball, it's like dribbling and bounce passes and rebounds and things like that. I mean, these are the fundamentals. So it's not a time to get fancy, but it is a time to do the right thing and focus on showing up every single day. And I think that will prove to you to be very valuable. Ultimately, here is my contact information if you want to reach out. It's just Tyler@cfcapllc.com. Rama, I hope this has been valuable for you and your community.
What changes are you making when deciding to acquire multifamily assets?
So the changes that we are, so let's see. So the question is, what changes are you making when deciding to acquire multifamily assets? So many changes, really. I mean, the way that we underwrite deals obviously has changed, and that starts with the financing. It starts with, okay, well, what opportunities do we have for leverage on these deals? So, of course, that has changed tremendously since March of this year, when we've seen the Fed really have a huge intervention, in terms of interest rates. So it starts there. All of the things that we talked about today in terms of, like, I think it's imprudent to go into a deal and say, well, we expect 10 to 15% rent growth over the next 3 to 5 years. I mean, I think you're setting yourself up for failure. While we've seen that over the past 2 years, it is not a proper, in my opinion, way to move forward. So you've got to look at rent growth and say, all right, well, what happens if this remains flat or is much more modest? Also, what happens if your occupancy dips and your vacancy increases over the next couple of years? What happens if it's stress testing your model? What happens if your delinquency grows? What happens if property taxes grow, unexpectedly, or insurance? I mean, the insurance volatility has been a big deal, and that's something that's grown significantly over the past few years, but I think you should anticipate that moving forward. The other thing is, again, we talked about this at some point in the presentation, was where do we truly anticipate interest rates being over the next few years? That is going to impact cap rates. It is. It may have not completely kind of been a function of the market to a huge degree just yet, but I would anticipate cap rates increasing. So the question is, well, what market are you investing in? What are you going in at in terms of your cap rate? Does that make sense? But I guess it's a little bit of a difficult question to answer because there's so many different factors, but it does start with the financing. And I think, ultimately our assets, the real estate assets and multifamily real estate assets in particular, they are somewhat of a derivative of the capital markets and of interest rates. So I think it's a good question, but somewhat of an interesting, difficult question to answer. But Rama, do you have any follow-ups on that?
So yeah, definitely. Like one of the main point you mentioned is, like, when you're selling the property, we will take care of we will consider only exit cap rate. The other thing we mentioned is we need to consider like interest rates also. That will also impact exit cap rate. That's very important point.
Yeah, and that was why I wanted to share some of those historical charts to show like where interest rates are today versus where they were, a few decades ago. And historically, we're still quite a ways beneath where things really went in the 80s and 70s. So, the question is, well, can they continue to run? And could that possibly be a function of the next 5, 7, 10 years? It certainly could be. I think it's important to focus on the fundamentals, and it's also important to be in a position to where you can hold longer if you need to, because you only crystallize a loss when you sell, or of course, refi is obviously another issue. But so it's important to finance your deals in a way that you can kind of hold for a longer term if necessary, and kind of weather that storm, if that makes sense.
Yeah, another one point I want to add is like loan assumptions is a good option, interest rates.
Yes, absolutely. Yeah, Rama, this has been a lot of fun, and it's here's the other thing I'll say is that this is when things really get fun, and to a certain degree, like the past few years have been easier than perhaps they should be, and they've had their own challenges, but this is when you start to get the creative juices flowing. For every problem, there is a solution. And I think that's the mindset that we need to have as investors, is with all of this volatility and with all this choppiness, is to come in to say, well, how can I solve these problems? How can I understand further the motivation of a seller to dispose of an asset? And how can we get to a creative solution? If for some reason the financing that is available to me is not getting me there, well, then let's look at this problem in a different way. So it's going to come down to creative thinking. It's going to come down to surround yourself with best-in-class partners and operators and all that kind of stuff. But ultimately, some creative thinking is going to be required to capture the opportunities, which could be, by the way, life-changing opportunities here over the next few years. So it could be very exciting and interesting to see how this all plays out. So I just wanted to add that.